Salam alaikum, good afternoon, thank you all. It's a great pleasure and a privilege to be here. Now, I've only got 20 minutes and I've got an awful lot to get through, so this will be our agenda for today. So we'll have a look at what's happening around the world, then we'll look at what's happening here in the Middle East, before we deep dive on the Kingdom of Saudi Arabia, of course. And then I've got three stories that I want to touch on: the capital, religious demand and events, before we look at the all-important future and, of course, the pipeline. So let's start with what's happening around the world and the global demand picture. So this is the number of rooms that we've sold across the world by month, indexed to the same month in 2019. And the good news is, as you can see, that for the last 15 months consecutively, we've sold more rooms than we did in 2019. So as a global industry, we're back, we're selling more rooms than we were. But the industry has, of course, normalized. So as a result, it's not all positive, positive, positive. And if we look globally, actually, the last 2 months, February and March, we saw a very slight 0.4% decline in global demand. Now, that was really driven predominantly by the US, particularly the lower class hotels there, but nevertheless, a very slight contraction. So although demand has grown, of course, so has supply. So what does that mean, and how does that translate into occupancy? So this is looking back at last year, occupancy full year 2019, and the percentage change full year 23, the percentage change to 19. And you can see for the vast majority of markets, we're nearly but not quite back. Nearly but not quite back to where we were. A couple of exceptions though, and note the Middle East is one of them, occupancy higher than it was in 2019. Average rates, very different picture, as we all know. They came back really strongly and very, very quickly as well. And you can see there, with the exception of China, which was later to lift restrictions, we've got double-digit growth when compared to 19 across the world. So rates far, far higher. But that was last year. What about this year? What about the first quarter? How are we shaping up? Well, obviously you saw there'd been a little bit of demand decline on a global level. And you can see there, North America, South America, Northern Africa, China, all a little bit behind year on year. But where isn't? Well, it's here, the Middle East. 3% ahead, and you'll note as well, the highest occupancy of any region globally in the first quarter was here at 73%. In terms of rates, still going up, 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 up. The rate growth has been accepted by the consumer, the demand is there, and we're able to push rates further ahead as a wider industry. So the Middle East, as you can see there, 6% up. So let's look at that in a bit more detail, at just how strong the Middle East is at the moment, or how hot it is. There's a lot of numbers on this chart, but this showcases the 6 key KPIs that STR track every day, week, month, and year. And we've got full year 2023, and then the percentage change to 19 and year on year. And it's almost a clean sweep, isn't it? Almost a clean sweep of positive numbers. But look at the demand since 2019, and think back to that first slide that I showed you, where that demand number was only just above the line. It's 17% here in the Middle East. Phenomenal growth. And if you look then at supply as well, we know there's been a lot of new supply that's come into the market. I'm going to talk about that more when we look at Saudi in more detail. But demand is far outpacing supply. Occupancies are going forward. Rates grew massively, although again, a slight contraction year on year. But look at the RevPAR, look at the rooms revenue. It's a picture of success. But we need to look at that supply and demand equilibrium, because it's so important in this region. And if you drill down and have a look at the key cities, this is rolling 12 to March. So April of 23 to March 24, percentage change. And it's a really, really positive chart. Look at the demand here. Doha up 31%, Daman up 29%, Salalah up 19%. These are huge increases in the number of rooms sold year on year. And with the exception of Mecca and Kuwait City, you can see supply is outpacing demand, so occupancies are moving forward. And we talk a lot about all of the new supply coming in, and we know there's been a lot. But if you remove Doha and Mecca from this chart, the biggest increase was 6%. So yes, it's a lot, but it's not a crazy amount. And if you look at some of those more established markets, such as Dubai, it was 3%, and Abu Dhabi, just 1%. So supply-demand equilibrium in most markets across this region is healthy. And we can see that when we look at the occupancy percent change year on year, again on a rolling 12 basis, overwhelmingly positive. What does that mean for actual levels of occupancy? Well, we've got some laggards there. Kuwait City, Salalah, sub 50%. But elsewhere, when you compare internationally, it's in the 60% range, pretty standard. But the biggest occupancies across the Emirates, as you can see, those three cities, mid to high 70s in percent terms. Now, average rates across the region has been a little bit different. We've seen a few declines, but don't forget how much rates had grown, so perhaps a little bit of correction there. Doha, of course, stands out, but that's a World Cup hangover as such. We're not going to command the same levels of average rates there. But don't forget about all the positives. Abu Dhabi, double digits. The holy cities, Mecca and Medina, double digits. Here in Riyadh as well, double digits. So lots of growth. And if we look at, again, the actual levels of average rates in US dollars, you can see, no surprise, it's headed by those Emirati and Saudi cities. And right here in Riyadh, the most expensive hotel market in the region, in the last 12 months, $227 average rate. So we've had lots of positive numbers there when looking at Saudi. Let's now deep dive into what's happening across the kingdom in terms of performance. And this first chart is exactly the same one I showed you for the Middle East, but obviously for Saudi Arabia. And I think in many ways it's even more impressive. So look at that demand number year on year, 13%. It's almost 3 times the amount that supply is growing. That is a healthy, successful market. Occupancy's up, average rates booming. You can see what's happening year on year in terms of RevPAR and revenue. Really very successful. But it's not just happened by any stretch of the imagination. This is going back to 2011. And you can see there's supply. Look at the trajectory, that very smooth trajectory, all the way up until COVID hits. And then as soon as we recover, we see a similar trajectory. We've seen the supply growth, the boom in this market over the last decade and a half. It's increased over that time period 53%. So that's a lot. But demand has grown 78%. So it's outpacing, occupancy is growing, and you can see there what's happening to RevPAR as well. And if you compare, yes, RevPAR is less than it was a decade ago, but remember, it was a very different industry a decade ago as well. If we drill down on a month-by-month basis across the kingdom, and we see the year-on-year percentage change. If we go to the start of this time series, we're still comparing to COVID, so those numbers are strong. We have Hajj in the June, so important, driving significant growth. But what I think is really interesting is just those last 6 months or so, we're still pretty much seeing double-digit growth year on year, and it's showing no signs of slowing down. Mostly driven there, as you can see with those blue bars, by average daily rates. So let's look at rate in a bit more detail. Now there's a lot of lines on this slide, of course, but we've got 19, then we've got 22, 23, and year-to-date 24. And you can make out there the year-on-year increase every year going forward. The big spikes, of course, the industry we know here benefits significantly from Ramadan, from Eid, from a rate perspective, and we can see those spikes ever so visibly. But let's drill down now and look at the key cities. And I think the most important thing to start that off is to start by looking at the supply picture. So this is last 12 months, and I've compared it to a decade ago. And you've got there the supply growth over that decade. Now, Medina stands out, obviously. After COVID, a lot of hotels didn't have their licenses renewed. They didn't reopen their doors, looking to improve the stock across that city. So that's flat. But elsewhere, you can see there, Riyadh 83, Jeddah 60, Mecca 56. And if you average that out over a 10-year basis, we're talking about 8% growth here per annum, 6% in Jeddah. There's big numbers to absorb. But the good news is the demand continues to grow and to outpace that supply growth. So if we look then at occupancy levels here on the left-hand side, you can see that for the most part, they're still growing. Dammam at the lower end, 57%, Medina, 71% at the high end, but most of those markets mid-60s in range. So that is very typical when you compare internationally. Now, average rates, there's a bit more differentiation across the kingdom, as you can see there. Those oil-driven markets in the east, lower rated, a lot of long-stay corporate business, obviously that is lower rated. We go from 272 riyals in Dammam, and then Mecca, Jeddah, Medina between 700 and 800 riyals, up to 850 here in Riyadh. So quite some variance in terms of average rate. Now, one more thing I want to touch upon before I look at the three stories is class. And when we look at this, we see a picture that is repeated across the world. And it's the higher the class, the higher the rate growth, the lower the class, the higher the occupancy growth. Now that makes sense, realistically. Those luxury and upper upscale hotels are only going to ever have limited demand because not all consumers can afford them, but those that can are less price sensitive, therefore rates are pushed more strongly. When you compare that to the lower end of the market, more cost sensitive, of course, but a demand base certainly. 15% growth in mid-scale and economy year on year. This isn't an area of the industry that really has attracted a lot of focus across Saudi Arabia. And when you look at our pipeline as well, in a moment you'll see not a lot of development, but certainly some demand there. So, let's move on and have a look at three stories that I've chosen to bring you today. And the first one is the capital. I thought it would be rude to come here to Riyadh and not talk about this amazing city. And this is that same slide, but just for the capital. And I think it's really even more impressive in many ways. Look at how demand has grown over recent years. 9% up year on year. And yes, there's been a lot of supply, but it's way outpaced by the demand. So occupancy's up, that's driving rates. It's a recipe for success. Of course, it is the gateway to the country. All that corporate demand, very much present. Lots of training, development needs taking place here before those people go out across the rest of the kingdom. So Riyadh doing very well. And again, it's not a recent change. Look at that supply growth. Really, really smooth, but picking up as we moved into the COVID period, candidly, as the kingdom opened up. And then you can see demand also, that bump as well. The changes that were made, the fruits of that, very evident when we look at the data. But Riyadh does remain a corporate market. And we can see that clearly when we look at our day of week data here. So midweek enjoys a 20% occupancy premium over weekends and a 100 Riyal average rate premium as well. But it is changing. More and more leisure attractions here in the capital. The 7 developments, the amusement parks, the Saudi Pro League. This chat might have something to do with some of the occupancy growth. But you can see here, Thursday night, 13% growth year over year. Friday night, 11% growth year over year. We're seeing more leisure demand coming into Riyadh, which is great. But if we look forward with some business on the books data, so this is hot off the press. We've only just launched this in Saudi. We'll be expanding it in the coming weeks and months ahead. But this is as of last week, the next 90 days occupancy on the books. And you can see there, Riyadh, it's pretty typical for a corporate market. You can see the weekday peaks and the weekend troughs. And then it goes off quite quickly. But of course, the corporate traveller has a shorter booking window generally. So not surprising to see that. Whereas Jeddah, it's a little bit softer, but the booking window is longer. Leisure travellers, longer booking window. And also, of course, the temperature as we move towards the summer, more attractive as a destination in that regard anyway. But lots of positivity here in Riyadh. Just want to touch on the holy cities quickly and look at how Ramadan performed in Mecca and Medina versus 2019. Now let's start in Medina. We saw occupancies ahead of where they were in 2019. Now, that shouldn't really be a surprise. Demand is up, and actually supply declined. It went backwards by 6%. So you would expect to see occupancy growth. But look at Mecca. I mean, this is phenomenal that occupancies are still at the level they were in 2019, despite an increase in supply of 20% over that time period. All of that supply is being absorbed. Really, really successful. And if we look at average rates, well, Mecca not quite achieving the rates that it did in that last week of Ramadan. Now again, 20% new supply, not particularly surprising, but also look at the strength of the rates that are being achieved, 2,000 riyals. Medina way ahead versus 19. Overall, again, some success stories for the holy cities. One other element that I think is really exciting for the kingdom is events, and the kingdom's ability to attract and then host small, medium, mega events. And if we look at rolling 7-day occupancy percentage change, you can see those spikes are very often being driven by leisure events, by corporate events. I appreciate there may be some Ramadan comparables in there, but ultimately it's driving forward occupancy and it's also driving forward average rates. So look there, the Formula One in Jeddah, 141% increase in rates. International Jazz Festival here in Riyadh, 108 increase. So really significant growth, and so exciting, I think, for the industry here, because more and more larger events, as I'll come on to, are obviously going to be hosted here. So let's now move and look to the future and the all-important pipeline. And I first want to do this on a global level. So this showcases the number of keys in the pipeline and then the percentage of existing supply that is in the pipeline as well. And you'll see there the standout is the Middle East. 32% of existing supply is in the pipeline, far exceeds any other global region. If you look at which projects are actually in construction, likely to open in the next 12 months or so, again, far ahead in this region. But when I talk about the active pipeline, what I'm talking about is signed deals, pen to paper. It's not the vision, it's what has been contracted and signed. So I think that's important to say as we go to look at the numbers that we have for Saudi Arabia. So where does Saudi sit in our global pipeline leaderboard? Well, it takes the bronze medal. And it's really impressive when you look, it's only those superpowers, the US and China, ahead. Then the biggest pipeline on earth is here in Saudi Arabia. So let's get rid of the US and China and look at that scale a bit more easily. You can see there, we've got 102,000 keys in the pipeline in Saudi, ahead of the UK, Germany, Vietnam, etc. And we always talk about the Middle East, and we talk about the Emirates and Saudi being the two powerhouses, the development powerhouses. But the Emirates pipeline is only 30% of what we have here. It's really, really all about Saudi at the moment in terms of sheer numbers. And to take that one step further, let's look at the cities, the global city leaderboard. Riyadh, and we do include Diriyah Gate in this, Riyadh is the city with the largest pipeline on planet Earth. 28,500 keys in the active pipeline there. You can then see London, my hometown, in second place, before Mecca, 23,000 keys. And not much further down either, Jeddah taking place there. So it just underlines just how important this country is when we look at development in our industry around the world. But it's not just in those big three either. What we can see here, yes, Riyadh, Mecca, we've got Jeddah, but Medina, 10,000 signed keys. We know there's going to be a lot more. Al-Kabar, 5,000. And then Saudi Arabia regional, which we consider to be the country, excluding those 6 cities, 23,000 keys. A lot of those all the way down the Red Sea, of course, with that giga project development. And it's really nice, I think, to look at the pipeline a bit differently. So let's look at it visually. Every diamond, every pin on this map is a signed project in the active pipeline. So yes, clusters in the cities, but look all the way down the Red Sea coast, dotted all the way along the coastline there. And if we look at the cities, this is Riyadh. The green dots are existing hotels, the yellow dots is the pipeline. It's really quite staggering, isn't it, when you look at that development. In Medina, the Ruwa Al Medina project to the east, all of the development there. Across Jeddah, 62 hotels you can see scattered from the north to the south of the city. And then in Mecca as well, 43 hotels, but the average size, 542 keys. When we look at our pipeline database, we've got 6 projects with more than 1,000 keys in the pipeline. But if we look at the demand, those rooms will get filled in due course. So, big numbers, but what does that mean in terms of existing supply? So this is important. So Riyadh, if all of those projects open their doors, supply will grow 136%. In Jeddah, it will be up 81%, across the regional countries, 78%. So it's huge. And if you then look at the class, well, it's all at the top once more. Luxury, upper upscale, and upscale classes. Very, very little at the bottom end of the market, mid-scale and economy. Now, we've seen this before in Dubai and Abu Dhabi, but interesting when you see the occupancy growth in mid-scale and economy across the country as well. Now, there's a big column for independents. I think a lot of those will get branded. They just don't have a name above the door quite yet, but expect a lot of them to get branded. So all this pipeline, what does it mean for supply and how it's going to grow? Now, if we just take the opening dates that we're given or we find available publicly, this is what will happen to the supply. It's going to explode, 20,000 keys every year for the next 4 years. It's not really reality, though. If we look at attrition and delay rates that we've applied to this data, this is what we believe will be the supply growth across the kingdom. So about 4% this year, 4% next year, going up to about 5% in the 2 years that follow. So it's manageable, more than manageable, with all the demand coming in. This is good for existing hoteliers and it's good for future hoteliers as well. But those rooms will be needed. If we look at some data from our friends at Tourism Economics, looking at the overnight arrivals indexed on 19 way out to 2032, they are forecasting overall a 400% increase. Name me another country that can say that. From Europe, 600% plus increase over that time period, although the Middle East and Africa and Asia Pacific will remain the key source markets. Phenomenal growth. So to conclude, Vision 2030, obviously we've heard a lot about it already. That's what's underpinning everything. And if I was trying to think about all the things that's helping our industry, and if we look at what the government have done with the e-visas, visas on arrival, Visit Saudi, the incredible imagery that we see on our TV screens, on our phones, on our laptops, the Ministry of Tourism with their incentives to attract investment into our sector, all incredible. The giga projects, only in their infancy, but can't wait to see what happens there. Booming. The airlines, they've been touched upon. Existing airlines, new airlines are going to bring people to the kingdom and increase connectivity around the world. It's still a corporate market for the vast majority of the time. But of course, not just Saudi companies. It's all of the international brands that have seen their focus on this incredible country. And it's events. It's Jonathan putting on Future Hospitality Summit. We've got Future Investment Initiative. We've got the World Economic Forum meeting in Riyadh today. And then you've got leisure, the Winter Games coming, the Asian Winter Games in 2029, the increasing prominence of the Saudi Football League and those mega projects, mega events, Expo in 2030 and the World Cup in 2034. Incredible. So much happening that's going to drive demand. But with that demand, it's important to ensure that the supply-demand equilibrium is there. And as I've shown you earlier, I think it will be. Do I think supply will pick up a little bit as we move towards Expo, and pick up a little bit as we move towards World Cup? Of course it will. These are mega events. It always happens. But the supply-demand equilibrium is really good at the moment. And then just to finish, because I'm over time, I was trying to think of a word to sum up what's happening here. And Gloria actually beat me to it in the last panel. But the word that I just kept coming up with when thinking about the industry and the development and the excitement is just that, quite simply, Saudi Arabia, it's unique. And with that, I'll say thank you. If you do want to receive a copy of the slides, there's the email. Get in touch. We'd love to hear from you. Thank you all. Enjoy the conference. Thank you.